One of the world's major central banks is going to be discussing taking its policy rates to zero. And they're going to do this not in some distant time period over some distant economic calamity in the 2030s. This is happening this coming week. I'm talking about the Swiss National Bank. Now, their policy rate's already down at half a percentage point, and the Swiss National Bank never got that far to begin with. But this global race to the bottom, as people have called it, that is not supposed to be happening, has been happening. And here we have the Swiss reacting to both economic circumstances in their own country, which are increasingly dicey. In fact, the prospect of negative consumer prices has risen a lot recently. This is one reason why this coming week, the central bank is going to be discussing taking their policy rate from 50 basis points down to zero. Now, it may be more likely they do a 25 basis point rate cut, but does it really matter at this point? They're already almost there to begin with, and they're likely to end up there in the short run. Like I said, not in some distant future date, but now. But here's the thing. The Swiss are not some massive outlier here. Central banks have been cutting rates and cutting rates more aggressively, and they've gone a lot farther and faster than most people seem to realize, because most people are fixated on the Fed, which is exactly what the Fed would like. When you stop and look at the rest of the global economy, the rest of what global central banks are doing, you will be surprised and shocked to learn that more central banks than not are most of the way there to the historic low territory that they had been in during the entire 2010s. The Swiss, like I said, are not some outlier. They're just at the forefront of what all the rest of the central banks are either doing now already or likely to be doing in short order. So you have the Canadians, you got the Swedes, you've got the Europeans, and a whole bunch more in between. And the question everybody needs to ask is, first of all, why this is happening? And second of all, what changed? Because if you go back to last year when the Swiss National Bank started, everybody said the low rates, the historically rates from the 2010s, they were never, ever coming back. And then less than a year later, we're facing the prospect of all of these historically low rates right now as we speak. So let's throw it over here to Mr. Van Meter. Steve, we have a central bank, a major central bank, one of the most respected central banks in the world, already talking about this week whether or not they're going to have a zero interest rate policy in early 2025.
Yeah, Jeff, it's pretty wild that we actually have seen this happen. I mean, again, you said this wasn't supposed to happen. A lot of people said we're in a period of structurally higher interest rates. We just went through a secular period of disinflation, which many people called for and said we're going to go through a secular period of rising inflation. And that means rising central bank policy to go with it. But as you pointed out, prices in Switzerland going negative. We see the same thing happening in China. Consumer demand is starting to decline in a major way. The other problem we have is coming out of the pandemic is a lot of the factories are really running fairly strong in terms of their output compared to where they were in the years prior. So we have supply rising, demand falling, and that means, of course, disinflation turning into deflation. And as we know, and as they always do, central bankers reacting to the data after it's done, not anticipating it. Yeah, they've got to cut. And so it makes perfect sense to me. If they don't go to zero, you're right, they're going 0.25%, but they'll be at zero here in the not too distant future.
Yeah, I think that's a really good point, Steve. Right, good place to start, because central banks are always reacting. And so when you look at that from that perspective, and you look at where interest rates are, central bank policy rates, and remember, we'll talk about this in a second, market rates were predicting this the entire time. But you look at where central bank policy rates already are, and if those policy rates that are already low and heading close to historical low territories, what have they already reacted to? That's really the question here. And what central bankers will say, by the way, the counter argument that they're going to make is that, oh, this is not a big deal. We're just normalizing our policies after a period of ultra high interest rates where we had to fight inflation. So we're just lowering our policy rates to where we think they need to be. The course that they call the neutral rate, when both you and I, Steve, we talked about this before, they have no idea where the neutral rate even would be, assuming there is a neutral rate at all. So the counter argument they're making is, okay, we're just reversing the restrictive policies of last year. We're not panicking over the prospects of the global economy in any way. We're simply just taking rates that were too high or too restrictive for the economy to continue. We're taking the harnesses off and letting the economy grow and breathe a little bit here.
Yeah, absolutely, Jeff, because this is a government's way of telling the public, hey, we're doing something here. We see demand going down, but we're really clueless. But we have this thing called a central bank, and they have this lever that makes rates go up and down. And if you lower rates, well, all of a sudden that means demand is going to surge higher and everything's going to be okay. But as we've talked about on the show, Jeff, and we look throughout history, we've not seen any effects of lower rates. In fact, central banks have started to cut rates, as you mentioned in the beginning of the show. And have we seen anything around the global economy say, hey, these rate cuts are working, demand is rising? We're not seeing that. In fact, we're seeing the opposite. We're seeing disinflation now start to show up as deflation. So, yeah, when we look at rate cuts, they mean absolutely nothing.
Well, what they do mean, and we said this a year ago, as this central bank rate cutting cycle got kicked off by the Swiss last March, and we've said this all along, we said, watch. What you'll see is once the central banks start, it will not be just one or two, like they say. The Europeans, when they cut rates in June, a couple months later, said, okay, we're going to cut rates once, then we're going to wait, and then we're going to cut maybe again, then we'll wait again, and we'll gently, softly cut rates a little bit here and there so that maybe over the next couple years, rates will go down to a little bit hot, a little bit lower than where they were last year, which was 4% from the ECB. They all said that they were going to go slowly. And you and I both said, no, 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 we watch. Once they get started, because rate cuts don't actually work, and they are simply a response to the weakness that even central bankers can see, you wait. Once they start cutting, they won't be able to stop. And that's really the point that we're making here. This race to the bottom that's a lot farther along than people seem to realize is that's exactly what has happened. The markets told us this was going to happen. The markets have been saying this is going to happen going back to 2022 and 2023 in particular. And then the early part of 2024, interest rates were saying central banks are going to follow the market because there wasn't inflation risk. The risks were all on the other side of the equation. And that's what central bankers are reacting to. And they're reacting to it in a way that looks a lot like the race to the bottom that we thought we had left behind in the 2010s.
Jeff, you're right. Central bankers are reacting to slowing global growth. Now, a counterpoint, we could look at the Fed. They're not aggressively cutting rates. In fact, Wall Street's expectations as of today is we're going to get two rate cuts this year, with the first one not until September. And from what we've heard from Fed Chair Powell and, of course, all the members, that they're saying they're not looking to cutting at the next meeting either. But the reality of the situation is they're reacting to tariffs. They're focused on inflation right now. They're not looking at the labor market. So they think, hey, if inflation goes higher, we need to maintain our policy. We need to keep rates high so we can reduce demand. But what they don't realize is that higher prices are the cure for higher prices, because American consumers can't afford them now. I don't know how they're going to afford them if they go up anymore. And yes, in the short term, the Fed's right. It's going to see higher inflation, but it's not going to last. It's no different than what we saw going in the global financial crisis. We saw energy prices drive the CPI up. And what happened? Incomes were slowing down. Consumers couldn't afford higher prices, and they couldn't afford higher energy prices. So what happened? Eventually, inflation turns into deflation. And at that point, the Fed's way behind the bubble. I think we're going to see the exact same thing happen again.
Yeah, it's important to point out there are a couple of laggards here. So while we look at the Swiss National Bank talking about going to zero, and like I said, they never got all that far to begin with. Their policy rate really got up to around 2%, not much higher, because that's normal for Switzerland. So they really didn't have far to go, but they've cut their rates by 50 basis points in December. They're close to zero to begin with. And then the rest of the central banks, okay, the Fed is lagging behind everyone else, but you look around the rest of the world. I did a video just recently, a couple of days ago, on Canada. The Bank of Canada started at 5%. They're already down under 3% at 275 and talking about needing to do more. 275 is only really about 75 basis points away from what everyone considers historically low rates. It may not be zero, but they're heading in that direction already. Sweden, the Riksbank, the world's oldest central bank, they started at 4%. Right now, they're down at 225. And like last year, the Swedish central bankers are all saying, well, we're at 225 and we can go carefully from here. But like I said, they said the same thing last year and they didn't go carefully. So they're already at 225 and getting close. The ECB, not far behind the Riksbank, they started at 4%. They're down to 250. So they're already in sight of 2% and ultra low rates already to begin with. Again, like I said, this race to the bottom is a lot farther along than people realize. Now, yes, the Federal Reserve is one of the laggards along with the Bank of England. The Bank of England started at 5.25%. They're now down to 450, just like the Fed. The Fed started at 550. They're at 450. So the question we're asking here, in terms of the context of central bank policies, if all the rest of the global central banks are racing toward the bottom, which they absolutely are doing, what are the chances the Fed won't be doing it? Because in a globally synchronized economy where all of these policies are a reaction to global economic factors, what are the chances, as Steve was saying, that the Fed is going to be able to ignore those factors, which it's not within the Fed's DNA. They have to react to it at some point. So the more central banks react, the more central banks race to the bottom, the more likely it is the Fed has to join in. The Bank of England will have to join in with the rest of the party.
Yeah, Jeff, and this has to do everything with the global supply chain. So you look to China, for example, major manufacturing base. You look at Germany, one of the largest exporters to the United States. And what are all of these countries starting to say? Hey, demand is going down. So yes, at the factory level, it makes perfect sense. As U.S. consumers demand less, well, that means new orders are going to go down and factories around the world are going to see their production numbers drop. But in terms of the US, why isn't the Fed cutting here? Because we're at the end. We're the last point. We're the point where goods are coming into the country. So we're going to see the effects of the slowdown far later than everyone else. So the notion that the Fed isn't going to cut. In fact, the Fed's going to tell us at their next meeting, hey, we're probably not going to cut that much. We think we're close to the neutral rate. Yeah, we think there's going to be some policy issues with tariffs that we're going to have to deal with. But yeah, we're not going to be cutting big because we don't need to.
Yeah, eventually that was almost, I don't want to say inevitable because you never want to use that term, but ever since you saw the yield curve invert back in March of 2022, forget the question of recession for a moment. What a yield curve inversion simply means is that rates are more likely to go lower over time than wherever they are at that given time. And then as the Fed raised rates back in 21 or back in 22 into 23, the market inversion got bigger and bigger and bigger, which was just the yield curve's way of saying you're going to end up right here. Now we aren't exactly at right here, but in taking stock of where we are today, if right here is going what the market was saying about interest rates going lower, we're a fair long ways toward that direction and toward that outcome. Like I keep saying, a lot more than people realize. The markets were saying rates are going to go down and go down quite a lot. And likely the swap market in particular said the rates were going to stay there. And yet, everybody said last year, no, there's no chance. Steve, you pointed out there was the idea that inflation was now structural and therefore interest rates were now structural. Taking all of this market information and just casting it aside and saying, we're not going to listen to the yield curve. The yield curve is wrong this time. Well, as we're seeing with central bank policies, forget the economics for a second, just from central bank policies, they're already confirming what markets were saying years ago.
Yeah, that's right, Jeff, because when you look at the Fed's policy and central bank policy, we can go back to post-pandemic. What did we have? We had way too much demand and not enough supply. So if you're the Fed and you only have one tool that's effectively raising lower rates, and you're trying to control demand, bring it down a little bit to let supply come into balance, well, what do? You raise rates because, well, that's the only thing you can really do. So it makes perfect sense of why they've done it. Now they're looking at the tariffs thing. Hey, we think prices are going to go up even more. So our solution should be to restrict demand more. What they don't realize is demand is already being restricted. It has nothing to do with central bank policy and it's going to get even worse. So what I see, Jeff, is a major policy mistake by the Fed. Now, I say that tongue in cheek as if policy from the Fed works, but if you believe in that and if you believe in the power of the Fed, then they should be cutting here like the other central banks are. But instead they're not, which is why they're going to be setting up for such a huge move back to zero when their day eventually comes and the data tells them it's time to cut.
Yeah, it's really, the Fed was looking at this from the perspective of regular economics, saying, look, we have to do this and we have to do that. We don't really care about what the economics of the situation is. But the idea, and you've said this repeatedly, you said this last year too, you said the Fed is going to come up with, or all the central bankers are going to come up with an excuse why they have to do this, right? And so now we have tariffs, which sound like the perfect excuse for, we had the soft landing nailed. We were right there, and then, oh no, it happened. Oh, Trump spoiled it on us. That's going to be the narrative. But one of the points I wanted to make in bringing all of this up is when you look at what central banks have been doing, including the Fed, this race to the bottom, which is a long ways into it, It began last year, long before the election was settled, let alone the idea of tariffs, which means that central bankers from the early part of 2024 to the middle and later part of 2024, before we got to the US presidential election, they were already starting and well on their way into the race to the bottom. So this idea that tariffs are the reason for it just doesn't fit with the actual data. What that really means is that, like we've been saying, the weakness has been there. The fundamental weakness has been there all along, and the Fed is just looking for a way to basically say, look, we had this covered, we had this going in the right direction, and something spoiled it. We could never have foreseen it. It was this unforeseen, unexpected thing that we just have to react to, even though we don't really want to.
Yeah, Jeff, that's exactly right. Because you look around the rest of the world, we clearly saw the slowdown starting last year. Now, what do we see in the labor market around the world is it's slowing. People are losing their jobs, hours are getting cut. Not seeing as much of that here in the US compared to other countries. And so, yes, the tariffs are absolutely giving all the central banks cover that they needed to say, hey, we had this, but there was this unforeseen variable, as there always is. As you said, Jeff, there always is something that comes along. And so we needed an excuse so we can now cut rates. The Fed doesn't quite have that yet. The labor market, according to them, is strong and robust. And at the moment it is. You look at, the unemployment rate, you look at continued claims, and it's holding in there. But there is a point. The question is, how long are these company executives going to stand by, watch demand go down, and keep a full force of employees on tap? I think they're going to be cutting hours in the months to come. I think there's going to be more job cuts, but then at some point it's going to spiral out of control. And that's when we'll hear from the Fed that, hey, you know what? It's time to cut. We know, though, they're way behind the curve because this was going to happen anyways, even if there were no tariffs.
I think really maybe the big lesson here is that when the markets have been warning that we were going to end up in this position anyway, they can't tell you when. And we've been talking about this ever since, for the last couple of years. They don't tell you when, but they do tell you with a fair degree of confidence about what is likely to happen. And in the most basic terms, what they said were rates were going to go lower, and they were going to go a lot lower, and they were likely to stay there. And here we are in the middle of that process. And what are we seeing? We're seeing one of the world's major central banks today in March of 2025 debating getting back to zero, and a whole bunch of other central banks that are following along. So as the markets had predicted, rates are going to go down. Well, central banks are already on their way to doing that and cutting and getting closer and getting back to zero. Lower rates, here they are. They're already on their way here today.
Yeah, that's right, Jeff. And then we look back to, where did this start? It all came to be because we had a supply and demand mismatch. And what did we see? Too much demand, not enough supply. So you got to raise rates from the central banker's perspective. Now what's the issue? Too much supply, not enough demand. There's your case. That's why we're going back to zero.